Now that rates have started to stabilize, we're starting to see some of the bigger institutions come back, and in some cases, we're starting to see multiple rounds of bidding for the same asset, which I haven't seen in 3 years.
Hi, I'm pleased to be joined today by Brad Cutsey, the CEO of InterRent REIT. I'm the lead manager of our real estate portfolios at Middlefield, and I've known Brad for over 20 years. I've owned InterRent in our portfolios for almost the same amount of time, and it's been a fantastic holding, and I'm really pleased to be joined by Brad today to get an update on not only InterRent and how it's dealing with some of the challenges in the multifamily market, but also to get a good overview of what's happening in the apartment sector in the Canadian market. So thanks for joining me, Brad.
Well, thanks for having us here, Dean. Really appreciate the opportunity.
So maybe before we kind of dig into some of the details on the economy or InterRent, maybe just describe a little bit about InterRent and how you're unique, especially relative to some other multifamily names in Canada.
Sure. So we focus on 4 core markets. We're in the Greater Vancouver area, Greater Montreal area, the GTHA, and Ottawa. That accounts for about 80% of our real estate level income. We are obviously a REIT, and we focus on distributions, but we're quite proud of our record of 8% CAGR over the last 10 years, and we've increased it over 5% every year. But what really gets us excited is the total return, and we really believe that it's our operating platform that allows us to kind of really focus on value-add initiatives.
So total return, that's near and dear to us as well, as is the yield, because we love getting the income and the growth in income over time. What is your goal for total return from an investor's perspective from InterRent looking forward the next 3, 4, 5 years?
I think we're at a wonderful time from a total return perspective. I'd be hard-pressed to give you an actual target, but I think something in the double teens is quite realistic, especially considering where we are trading currently relative to our book value. We're trading at a point in the cycle that is at a pretty steep discount and doesn't really match up to the long-term fundamentals that are ahead for us.
And do you think this pickup in return and narrowing the discount may come from a lot of this cash that's been sitting on the sidelines in Canada, sitting in GICs, sitting in term deposits? Do you think that's going to help InterRent and the REIT sector generally?
Yeah, it's a great question. It's one that I get really excited and I smile to because, as you know, we've always focused on what we can control, which for us is operations and growing the NOI. But for the last 4 years, we've been at the mercy of the macro headlines and an increase in interest rate environment and watching people flow out of the sector. For the first time in a long time, I would say in the last 3 months, Dean, we've had a lot of conversations with generalists and different institutional sales desks wanting to get reacquainted with the REIT world because they're starting to see a lot of that money come out of the GIC and want to go back into more defensive type yielding equities.
I know a lot of the banks have published research just in the past 2 to 3 months indicating that not only real estate dedicated investors like Middlefield, but even, as you say, the generalists starting to wake up to where can I get yield because my GIC is no longer offering me 5%. And we've seen 3 rate cuts out of Canada. You're probably going to see at least another 3 or 4 more. So I tend to share that view that the momentum is building for this cash to come in and looking at attractive value opportunities like InterRent. So with this reduction in rates, there's been lots of talk about, what's happening in the economy. Is the economy slowing? Do you think we actually are able to sidestep a recession? And how does InterRent interplay with this changing economic backdrop?
Yeah, it's actually one of the nicest things about the multifamily asset class. I mean, real estate is very capital intensive and tends to follow inversely rates of interest. However, when you have a decrease in rate environment, sometimes the suggestion might have a slowing economy, and sometimes it might be recession. the nice thing about history, what history tells us about multifamily asset class, and we've seen it in our own portfolio, is we play really nice in the economic cycle. Meaning, there's not a big, we don't have big variances in our occupancy when you do go into a slowdown. It's only if it's an extreme deep slowdown, we're going to really see things spike maybe by 6-7 basis points. Typically, what we've seen in the last 3 recessions, we haven't seen an increase as CMHC statistics. So this is the whole industry, haven't seen more than a 90 basis points increase in your vacancy rate during a recession. So it's one of those things where we're in a structural undersupplied market. We're going to continue to see rent pressure, and things got to get really bad in order for us to see a material change in our cash flows. So it's got great cash flow visibility.
So it's clearly very defensive, and history has shown us that. And I think, as you just touched on, I think the other factor here is that in Canada, where you operate, we've got this massive imbalance between demand and supply. Give us your thoughts on that, and is that something that's going to be resolved anytime soon? And what are the challenges to increasing supply to meet this strength in demand?
It's no question. It's being talked about a lot, is the housing affordability issue that we're in and how undersupplied we are relative to our population growth, to the point where there's a lot of foreign investors looking at a space. How do they participate in what I would call a structural disequilibrium? We're working hard as an industry, Dean, to try to resolve that, and for at least the publicly listed REITs, myself and our peers, working extremely hard, working with all 3 levels of government to try to be a part of that solution and help deliver the supply. But the reality is the amount of capital that's needed to deliver, by some estimates, there's estimates out there anywhere between 400,000 to 600,000 of additional homes needed to be supplied each year to reach what CMHC calls equilibrium, which is 3% vacancy rate, needs to be delivered. To put that in perspective, we had a record year of completions in 2023 at 242,000. So that's no short order, and you need the capital to do it. You need the trades to do it. We have over 500,000 tradespeople retiring in the next 5 years, and it takes us 3 times more workers per home than it did back in the early 90s. So we're not as efficient. We're losing resources, and we're losing the trades to do it. And the amount of capital that we have to attract in order to deliver that, it's just an insurmountable task.
So it sounds like a challenge, to say the least, which tells me then that there's going to be continued upward pressure on rents and the rents that InterRent is charging. So what have you started to see there in terms of your rents? What's your average rent today? How do you think it grows here over time?
Yeah. So right now we're around 1,650 in place. We have a mark-to-market estimated gap of about 30%. So we think there's a 30% lift to be had as our units turn. And we've been on the top line saying that we think we can do 5 to 7%. What that translates into income at the operating level translates into high single-digit, low double-digit growth. And as you know, Dean, in real estate, if you can beat inflation, you're ahead of the game. And I think this far surpassed inflation. So from a fundamental perspective, we're really optimistic.
Now, the other thing, as you touch on kind of NAVs, and we're at a discount to NAV, and I think you make a compelling case for growth in price to start closing that discount. But what do you think happens to your NAV here? Because over the last few years, you guys have increased the capitalization rate, which is the denominator in the NAV calculation, which actually puts downward pressure on your NAV because interest rates have gone up. So you've done the right thing there. NOI has been growing up, and I think you're making the case that your net operating income will continue to go up. Cap rates now, with rates plateauing and going down, are likely to come down as well. So do you think your NAV starts reaccelerating higher again?
I do. We can't control the fund flows, like I said earlier, but it's definitely, to us, feels like rates have stabilized. And as interest rates have stabilized, I think at best, cap rates stabilize, if not, to your point, contract. But that's just gravy for us, because on the flip side of that, we believe that we're going to be able to continue to grow NOI. And that should put us,
That's what you can control.
that's what we can control, and that's what will help continue to increase that book value.
The other thing that's been talked about in the real estate area and specific to multifamily is there hasn't been a lot happening in the private market, which then not only frees up capital, but it also validates, the value that you're reporting to your unit holders. Do you see any changes in private market activity, Brad, as we say, rates have now plateaued and are coming down?
Well, I'd start off by the fact that we have disposed of some communities where we maximize the value of those communities, and we've done them at our book value. So we have validated our book value, but I would also go to say that up till about 3 months ago, it's really the private market, not a lot of institutions. It was kind of pens up, and it was a deal ticket of $15 million or less. But these are investors that look at real estate as a wealth preservation, and they're not as concerned about buying with leverage, so they could wait till it's in the attractive part of the financing cycle, which all day long. Now that rates have started to stabilize, we're starting to see some of the bigger institutions come back, and in some cases, we're starting to see multiple rounds of bidding for the same asset, which I haven't seen in 3 years.
And from InterRent's perspective, you've done an excellent job on value add, buying older assets, upgrading them, driving rents higher. You haven't been as active on the acquisition front. How do you think that unfolds over the coming years?
We're excited. We have a little bit of a hole in our 2029 maturity ladder, debt maturity ladder, and right now you can get 5-year money at 3.6. So things have come back in the realm where things start to look pretty attractive. I think you're going to see us invest in older communities and reinvest in them and bring them back to life and be able to make those viable homes. And quite honestly, they tend to still be the most affordable part of the market. And I think you're also going to see us leverage our operating platform and maybe participate in some of the new product where it makes sense and augments our existing portfolio.
So it sounds like an interesting barbell strategy. You're clearly playing the affordable space, which we know has been a challenged part of the apartment sector in Canada, but you're not going to be shy about participating in some newer acquisitions where you maybe don't have rent controls, because anything built after 2018 can mark their rents to market each and every year. So as a final point here on InterRent, what you want to leave with our investors, what's the best thing to describe what you're doing with InterRent and why it's a great opportunity right now?
I think really we're in the people's business, Dean. We're talking real estate, and this it's the great part about real estate. It's the brick and mortar, it's the land, it's the residual value. We're very urban, so there's a lot of defensive value in it. But what really generates that NOI growth and our ability to be above average on industry-leading KPIs is that operating platform. And while we weren't as active over the last 3 years, we were being extremely active in training and reinvesting in our operating platform, investing in technology to make the lease journey more convenient and a much better experience for potential customers. And we continue to invest in our brand. And I think as supply gets delivered, it's not going to get delivered fast enough. We all know that. But supply will get delivered over the next 15, 20 years. We're going to be the number one choice to kind of deliver that ultimate consumer experience, the place where you call home.
Interesting. Well, thanks very much, Brad. Keep up the great work, and we'll look forward to being a continued investor in InterRent.
Great. Thanks for the support, Dean.